Hi everyone, this is Rob Roy and welcome to the Elliott Elite U.S. market update. It was a rough week for the markets ending on Friday the 2nd. You can see that we moved to the downside here. A little bit of a bounce here on Friday. A lot of news for the market to digest. We had the news of Trump's announced tariffs on some of the metal companies. Is that going to initiate trade wars? There was some rhetoric from the WTO that threatened sanctions if the U.S. went through with these tariffs. That sent the markets reeling, and we got a little bit oversold going into Friday and bounced back. We also have Japan hinting that they might end their QE program. It's called QEJ, but quantitative easing for Japan, which is the Japanese government following along with Federal Reserve's quantitative easing program. And if they start to scale that back again, that's a withdrawal of liquidity. And then somehow we got Putin weighing in with the fact that they have missiles capable of potentially reaching the U.S. or U.S. based land. So lots for the market to digest, none of that sounding very positive, and so you can see we move to the downsides. Take a look at the 10-day moving average, and if you've ever listened to anything that I've said over my 21 years of trading in the markets, one of my primary rules is that no security in any time frame gets very far above or below its 10-day moving average. It just doesn't happen. And on this chart here on my integrated investor, it's in the lime green because I always want to be able to see that right away. That pulls my eyes to it. It's neat that you can make these different colors, whatever coloration you want. And so you can see that we're right here. And then on Thursday, notice the distance that we got away from the 10-day moving average, getting a little bit oversold, hence the bounce back up. And even with the bounce on Friday, we didn't recover back to the to that 10-day moving average. Also interesting that we have all of the moving averages converging here, and you can see that we are consolidating in what looks to be forming as a bit of a triangle. And as you know, a triangle is one of the Elliott wave corrective patterns. But let's take a look at the Fibonacci ratios and numbers, and from that big drop that we had into early to mid-February, we recovered. Now remember, I mentioned to you that you have to hit the 78.6% level to nullify a potential downward zigzag. So at least at this point in time, we still have that potential in place. So it's what's known as qualified. And again, we want you to learn all the proper terminology when you're talking about Elliott wave, when you get into Elliott wave circles or just trading on your own. You want to learn properly, learn not just the percentages, the levels, but learn the terminology as well. So it's still a qualified potential zigzag to the downside. As you can see here, would have been better for the C wave to the downside had we closed below that 38.2% level, but again, we showed you why. We likely bounced on Friday was just due to the fact that we were a bit oversold going into Friday's move. So if we hit this 78.6% level, what that means, and this is why I love this Elliott wave trading so much, and utilizing the tools of Profit Source and Integrated Investor, is it's just so clear and easy to see. So if you're trading to the downside, if you're trading the C wave lower, your stop loss is simply right here. And if it hits that, boom, you get out. So if you entered when we hit the 61.8% level, you're profitable at this point in time. Now, if it moves back up and we hit that level, it's still a small loss. And then you move on to what would be the next move, which is very likely a move up to test those highs. So you just reverse and trade to the upside. But again, we have to hit that level first before we can talk about that being nullified. So right now, that downward zigzag is still in qualified range. So we have this A segment here and the B, and then right now the potential for the C wave lower. Want to look at the SPY. As you know, we look at that to bring volume into the mix. And pretty interesting that we had the big volume down on Thursday when all that news was announced, and that's to be expected. But look, we had above average volume on the recovery on Friday, so there's some legitimate buying coming in on Friday. We also have to remember that we had a big down week. we're moving into the weekend. People that were trading to the downside are squaring off their positions and evening things out, moving into the weekend trade. So there's a lot of things that factor into that, but quite often you'll see below average volume on Friday. So to see above average volume on Friday, you have to respect that bounce and to see if there's something more to that. But again, are we forming just a plain old triangle here where the market will then make its break one direction or the other? That's going to be the key for next week following the March 2nd close. Also wanted to show you the VIX. We've talked about that, and boy, you know, were we spot on. We always get criticized when we're wrong, so let's take our kudos when we're right. Elliott Wave certainly helps us to facilitate being right more than we're wrong. That's the beauty of it. And we mentioned last week that 15, which had been resistance for so long, would likely now be support. And as you can see, we came down, we found support right at that 15 level, bounced up. That coincided with the downward move that occurred here throughout the majority of the week. So the 15 level is key to watch. As long as we stay above that 15 level, with the added volatility, you have to respect that C wave to the downside. If we break back below 15, if we break that support level, then that could give some credence to the fact that maybe we are going to bounce all the way back up, nullify this C wave, and then we move back up to test the highs. So the question becomes, and isn't that interesting, where we just talked about this triangle, that's where the market is. Are we going to move down, test these lows and break the lows in the C wave, or are we going back to test the highs? When you have a question like that, it lends itself to a triangle, which gives you a potential breakout one direction or the other. So everything is falling right into the hands of Elliott Wave analysis here, especially right now with the corrective patterns, which are flats, zigzags, and triangles, if you're not tired of hearing me say that. Wanted to bring we introduced the dollar, so I wanted to bring the dollar back into play here. Again, a rising dollar with interest rates moving higher would certainly give us the potential for another downward move. And then here we are following right as we've been, bouncing back and forth around this 161.8% extended downward move. So we were at support right here at the 161.8. Is the dollar going to find that support and move higher? Again, that could easily coincide with a downward market move. If the dollar were to move lower and then head down towards a 261.8% level, which would be the next fib level. Remember the summation series in Fibonacci lore, you add the previous two numbers to give you the next. So it works with these ratios as well. So we add the 100, which is the previous level, to the current level, which is 161.8. Add those two together. That gives you the next level, which would be 261.8. So we'll see how that plays out, the dollar over next week. Also wanted to bring in another chart. Well, let's look at TNX real quick. Let's look at the 10-year interest rates. But then I want to bring you into something else that looks quite interesting. And you can see we're consolidating here. And isn't that interesting? We have this big rally move here, which we've highlighted before. And now look what's happening. We are moving into a little bit of a triangle. It's not a very big one, but the consolidation is a triangle following an upward move. And if we had options on TNX, this would be an ideal opportunity to put a position on here because this is one of my favorite patterns where you have a big directional move and then a consolidating triangle following it. We don't have options on TNX, so we can't do that, but that would be an ideal position. And so we're going to get some sort of a breakout, about a 1.5 move out of TNX. And as you know, if we break to the upside out of here, we will be pretty close to hitting our upward target. Again, go back and look at the previous recordings if you want to see exactly where that target is. The chart that I wanted to bring in is one that's been talked about quite a bit here in the U.S., PAC, Paycom Software. And look at this pattern here. Again, talking about zigzags. And you can clearly see this support level right in through here. right there at 75. Notice how we went sideways for so long. We broke above it, tested it, broke above it, tested it. So what was resistance going into October has now become support. And also, look right here on this day, which happened to be December 5th, a doji. And then from the doji, we move to the upside, and there we have our zigzag developing. So I'll take this off just because I want the chart to be pardon me, cleaner and easier for you to see. And then there we have our impulse move following that doji on the 5th. And then we have a retracement, so we want to measure that retracement. So we go right back to that point where this impulse move started, and we come down, and there we are at the level we've talked about in ad nauseum, 61.8%, my favorite Fibonacci level, the strongest Fibonacci level, in my opinion, for support and resistance. And so we have a very clean-cut B-wave correction right down here to the 61.8% level, and then we bounce from here into the C wave. So from what we want to see here is there any more upside out of this potential pattern? So let's bring in the Fib extension tool, and we follow along with what we saw with our impulse move down to the 61.8% level, and we are just breaking above that 100% level. Now, again, to reiterate the rules, because we had a 61.8% retracement, our extension target is 100%. What we want to know is, are we going to move to an extended C wave, which would bring us up to 161.8%. So to label this, we have our A wave, that's our main impulse, then we have our B correction here, and now we are in the C wave. Now again, I want to emphasize this, that we have followed all the rules. We have not just a qualified zigzag pattern, we have a completed zigzag pattern based on the 61.8% B wave correction giving us a 100% extension. What we want to know is, are we going to get an extended C wave? And so that's what this would mean here. So we would say, is this going to be an extended C wave? So we'll have to wait and see what next week brings, but I wanted to show you that. Now I pause for a second because I want to take all this stuff off, and if you've been following along for the past few months with these recordings and enhanced Elliott Wave education, you should have noticed something here. So this is a little bit of a test quiz, if you will, where I've been walking you through the primary zigzag pattern. But while I'm taking all this stuff off to clarify the chart, take a look and see if there's anything else that you may notice that could have been a tradable pattern within this overall larger zigzag pattern. Now remember, we started down here, right here on December 5th with our doji, right, bouncing off of support. I mean, it couldn't have been a more classic start to a zigzag pattern for this impulse move that went up into the middle of January. But hopefully what you noticed was this move here, right here. So I'm going to take off this arrow and put it back with a blue line, but I'm going to wait before we do that because that's going to be labeling a position. Let's see if this is anything that we would want to pay attention to. So we move there, and lo and behold, we come right here into this 38.2% level. We did touch 50, but look at all this consolidation here at 38.2%. So that qualifies as a B wave correction. Okay, so that means we qualified as a B wave correction. We didn't quite make the 61.8% to give us the 100% extension, but we did have a qualified correction. So we can now label this. Now we already know this is a primary A wave. So in the beginning, if we had started this pattern right here, we would have labeled this as the A wave here, and then the B correction, and then our C wave extension. Let's see where the C wave extension moved to. So again, we come down here, boom, down to our level. And isn't that amazing that right where we were down here on the correction, right up to the 161.8% extension. So we had an extended C wave, not just a qualified C wave. Look what happened at the 100%. We went sideways here for a few days because we touched that 50% level. Remember, 38.2% qualifies. Then we went to 50%. That's right in the 100% extension with the 61.8. But we went right past that. So we have the 100% extension and then the 161.8%, which means it's a extended C wave. So this would have been a completed C wave here, and then moving that up to here gave us the extended C wave. But it's fascinating. Look at all of this resistance. Right here, again, at this 161.8% fib level, Fibonacci at its best. So what does all this mean? Because as you know, at this point in time, we now know that we had a larger zigzag pattern. Initially, that would have been a completed zigzag, ABC. But then we know that from there, we had this move, a larger correction, and our C wave that we're wondering if it is complete or going into an extended C. So what this means is that we had a complex A wave. So we relabel this, take these off. You could have traded that. It was a very tradable move. But remember that this is the primary A wave impulse, which we now know is complex. So let's just go ahead and put that on there because I like to label charts properly. So we'll just add in the words here, complex. So we have a complex A right here, which was the main A. So what does that mean? What do we do for the other ones that we had? I'll go ahead and label this as the full-fledged B as well. Well, you use small letters. So we come here, and now this is small letter a small letter B for the correction, and a small letter C. So the complex A wave also completed a zigzag pattern. What does complex mean? If you've been away from Elliott Wave for a while, or you're new, just coming back up and renewing your data feed for your profit source or integrated investor, and you're new with us, I encourage you to go back and look at the previous recordings. There's great information there. We've been so spot on. Or I shouldn't say we have. Elliott Wave has been. I'm just interpreting what Elliott Wave is telling you on these charts. But we have a complex A wave, so that means that we have the small letter ABC, and then we have the bigger pattern. A complex wave means a pattern within a pattern, or a wave within a wave. So we know we had a strong A wave impulse, but within that, you can clearly see where we had the smaller zigzag pattern here, which caused it to be the complex A. So there's so many different ways. I'll get this here in a second. There's so many different ways that we could have traded this, but every bit of it have followed the rules to a T. So this trading thing is not that difficult if you learn the rules. The key is you have to learn and understand the rules. If you try to do it willy-nilly or without fully understanding what you're doing, far more difficult. But as I've mentioned so many times here, although I look at complementing indicators like the DMI and the CCI, if I was ever forced to just rely on one indicator, I can't see, and I don't know how you could argue, if you've been watching along with how we've been interpreting the markets and these individual charts showing you Elliott Wave, how you could find an individual indicator, technical indicator, that's any better than Elliott Wave. So if you had a wonderful week, we'll be back to talk to you again next week. We have the jobs report next week. And I also thought I would throw in, while we're talking about sentiment, we usually add this in with the VIX, the Bulls and Bears survey from Investors Intelligence. The Bulls have taken a nosedive down, as you would expect, but interestingly, the Bears moved lower. The Bears have been staying steady as the Bulls have been decreasing, but now we actually had them move lower in the bears. So that's something interesting to take a look at. So what that means is that we have fewer strong bulls than we had, but now we have even fewer bears. So we'll see how that plays out. But it's already done its job. We had that way overextended reading on the Bulls versus Bears survey, which you heard me talk about. We had this big move down from the end of January into the early part of February. That was telegraphed there, so we had that. It's going to be very interesting to see how this plays out over the next week or two. Again, look forward to talking to you again next week. Take care, everybody.